Okay, this is the second video for how we're going to walk through the construction of a statement of cash flows. So if you remember from the first video, and if you didn't see the first video or don't know what I'm talking about a first video, don't watch this one till you see the first one. What's going to happen here is I'm going to walk through building a cash flow statement, and this problem that I'm using is actually from your textbook. It's P13-2. And in the first video, I showed you how to identify whether something was a source or a use of funds, as that will help you determine where things go. We also talked about operating activities, investing activities, and financing activities. And as a reminder, operating activities are those accounts that are involved in day-to-day operations. In other words, what you do for a living. So accounts payable, accounts receivable, inventory, supplies, prepaid insurance, advertising, rent, all those types of things are related to the operating activities. The investing activities are anything that we are either kind of property, if you will, things that we either invest in ourselves, we buy additional equipment, additional factories, property, that type of thing, or we sell it. So it's the inflow and the outflow of cash based on us investing in ourselves. And then financing activities have to do with things that are related to like stocks, retained earnings, dividends, those types of things. So it's how we actually get financing for the organization. It could also be things like bonds payable, mortgages, those types of things. So long-term debt, but it's how we raise funds for our organization. So we're either taking money in some ways, we're borrowing or selling stock, or we're paying money back out. We're either buying some stock and putting it into the treasury stock account, or we're paying off our long-term debt. So things are going to either be a source and increase the amount that we're going to put into our cash flow statement, or they're going to be a use of funds and they're going to be decreased here. So I set up the start of the statement. Whenever you create a financial statement, this is proper form. You have the name here. This whole area is centered. Here's the name, BG Wholesalers. This is called the Statement of Cash Flows, again centered, and for the year ended December 31st, 2013. It is always for the year ended, for the quarter ended, for the month ended, whatever your time period is, that's what you use, ended, and then the date. That goes the same way for the income statements and the statement of retained earnings. The only statement that gets an actual date, if this was the balance sheet, we would just have December 31st. So a balance sheet is a snapshot in time. All the rest of them are an accumulation of an entire period of time. Okay? So you have three different sections: the cash flow from operating activities, cash flow from investing activities, and the cash flow from financing activities. So I always start with net income. Whatever the net income is, I just put that in first. And then I go in and I add all of those types of things. So if you have your sheet, if you went ahead and did the work on the first half, you either have the worksheet that I laid out, or you've just sat here with a piece of paper and you've listed every single change in the item from the balance sheet provided on page 297. You've gone through each one of those items and identified where we're at. And so what we're trying to do is we're trying to determine what the net increase and decrease is from cash. We're going to add it to the 2012 cash balance, and if we've done it correctly, we will get the 2013 cash balance. Okay? So here we go. So we don't deal with cash. I said the cash from the balance sheet there, that particular thing is done at the very end of this statement. So the first item that we're going to flow on normally would be, just go down the list, accounts receivable. But I'll tell you, only because this gets forgotten an awful lot, I always start with net income here, and then the very next one that I do something with is depreciation. Okay? And so I will add depreciation. And the reason I add depreciation is always an add, always, always, always an add. It is never a subtraction. It's never a use. It is always a source. And I explained this in the first movie. The reason that it's a source is because depreciation is an expense. Expenses subtract from net income, and when you subtract from net income, that lowers your income tax. So this is a positive $5,000. That's going there. Now we deal with our accounts receivable situation, and our accounts receivable is going to be a subtraction. Let's create a little subtraction section here. And let's see, I probably should do that like that. There we go. That's better. So then the things we're going to subtract from our operating activities is going to be accounts receivable. And we said accounts receivable is a use. Now, accounts receivable did increase. It went up $4,000. Okay? But the issue here is that if you remember what we're talking about, any increase in assets from one year to the more recent year, any increase in assets requires the use of cash in order to make that happen. So in this case, we sold something to somebody. We either sold them some services or we sold them our product, but we didn't get paid for it yet. That's why it's accounts receivable. They still owe us money. So our choices were get the money, which would have increased our cash, or not get the money, which doesn't increase the cash. So since accounts receivable is not get the money, at least now, this is a use, so it's subtracted. So that's accounts receivable. So then we work our way down. Merchandise inventory is the same thing. It's an asset, and she goes down. And the reason she goes down, even though we increase merchandise inventory, again, an asset, whoops, went too far. An asset that goes down, that goes up in value, you have to have cash in order to make that happen. Some money had to be spent. Assets don't just appear out of thin air. So you have had to have done something, spent some money on something, or did something that cost money in order to make that happen. So that's why that goes there. So I'm going to pause here for a second. I'm going to fill out some more of these. I'll come back and explain them to you. Okay, I've completed the operating activities section. So let me kind of walk through it a little bit. We had depreciation in accounts payable. We had accounts receivable. We did merchandise, okay? And then the only other thing that we had to deal with, now merchandise again, it works the same way as accounts receivable. Whenever you have assets that go in the same direction, they're going to be in the same spot. If they go in a different direction, that's where they're in a different spot. So accounts receivable actually, because we ended up not having to pay, right? Accounts payable is a situation where we're buying on credit. We didn't have to pay. So we bought something. We didn't use our cash. So that's actually added back in as cash that we get to keep. Accrued wages, that's the other item that I added. There was a $200 difference there, and there was a decrease in this. Whenever you decrease a liability, a decrease a debt, the only way that happens is that you pay it off. So in this particular case, that's why we're subtracting it, because we're using $200 of additional money to pay it off and make this smaller than it was in the previous year. So all I did is I then added up all of these numbers, again, in parentheses is subtraction, so 5 and 9 is 14, subtract these out, and you end up getting 6,800. So I total these together. I start with net income, and I add this, the items of cash provided. So total cash provided by operating activities is these two numbers added together, $19,000. Okay, so if we move on to the next two areas, the investing activities have to do with any type of equipment or buildings or factories, property, plant, and equipment, that type of thing, fixed assets that are considered investments in ourselves that we've either bought or sold during the year. So if we go back to our book, problem 13-2, and we take a look at page 298, the first item there, bought equipment for cash. Well, hopefully we'll be able to look at that and say, well, if I bought equipment for cash, do you think this transaction caused our cash to go up or down? Hopefully you'll be able to see that this is a use of cash because it said bought for cash, and so you will actually subtract the cash purchased for the fixed asset, or you could call it equipment, whatever you wanted to do. And just so you know, I'm shortening the things here. Normally you'd say something like, increase in accounts payable, increase in merchandise inventory, or decrease in merchandise inventory, depending on what makes things do these items, do these particular positives and minuses there. I'm just trying to make this a little easier for you and not complicate it with all kinds of additional words, but they actually have examples in your book of what this statement looks like in actual perfect form, along with the videos that I showed you. I'm just trying to keep this reasonably simple for you so you can figure out the basics of how to do this. So in this particular case, we have a situation where this is the only item. If you look through everything else, we got long-term note payable. That's the financing activities, because it's how we're financing our company. Sale of stock, dividends declared, blah, blah, blah. So all that other stuff, nothing is related to investing activities, so this is the only thing that's in there. And because we're talking about this being a subtraction from our cash balance, because we paid cash, we're going to make that a negative. That takes us to cash flow from financing activities. Okay, so we have our fixed assets section here, or our fixed asset item, which was equipment. We could have called it equipment if we wanted to. I just termed it fixed assets. And so the fact is that we used cash to buy it. We've talked about that. So there's your $21,000 negative. And that's the only thing that's in here. So the net cash flow from investing activities is a use of cash of $21,000. So hopefully right now you can see that from operations we're good. This should always be a positive number. If not, you don't know how to run your business, or you had a really bad year. Hopefully this doesn't become a bad year every single year. If this is a negative number, that means you're not making any money in your business. So this is positive. Financing ourselves or investing in ourselves, $21,000 on the negative side here. Okay, so far we're $2,000 in the hole. Hopefully you can see that, because this is increase to cash and this is decrease to cash. But we know, I mean, even if we don't know how to do anything else at this particular point, if you remember and you go back and you look at the previous video and you go back and look at your book, we actually had more money in the account, in the cash account at the end of 13 than we did at the end of 12. So at this particular point, if we move on to the finance activities, this is investing, getting additional investment dollars. So additional long-term borrowing, it is a negative amount because it's lower, so we've actually paid more of our long-term debt off. So that's a use of cash. There's the $6,000 difference from last year to this year. But we issued some stock, and when we issued some stock, we've got $16,000 in additional cash, so that's why it's a positive. And you combine a negative $6,000 and a positive 16, that gives you $10,000. Okay, so how do we finish this up? Well, you take your totals from your three sections. This is net cash provided by operating activities. It's a positive $19,000. Net cash flow from investing activities, it's a minus $21,000. So hopefully you can do that math in your head and show that you're $2,000 in the hole. And then the last one is net cash provided by financing activities. So we were $2,000 in the hole plus a $10,000 positive. Hopefully we can see very easily that the net increase in cash is $8,000. So $8,000 goes here. Then we go back to our problem and we find out what's the beginning balance of our cash for 2013, January 1. And I believe that was $29,000 if memory serves me. So then we go our cash, we add these two together and they should equal the cash balance that we have at the end of the year. And that balance is $37,000. If you go back and look at your book, well, those two added together are actually $37,000. So that's what you're supposed to do. If you get to this point and you don't have that number, so if this number plus this number to give you this number, if this number is not the ending balance of your most recent balance sheet for cash, then something's wrong. That has to balance. So hopefully, between the first video and the second video, this shows you everything you need to know to actually walk through an entire statement of cash flows in the indirect method. And good luck to you on your project. Don't forget to ask some questions.